Thank you very much for joining me on this video. In our last video episode, if you recall, we talked about spending money in repair and maintenance or upgrading, and we saw there were two ways to handle those expenditures. They could either be capitalized or they could be expensed. And if they were expensed, that was a dollar for dollar claim on your income tax. If they were capitalized, they would be depreciated over time. What I want to look at today is this whole aspect of depreciation. You know, businesses have components that wear out. We think about restaurants. They've got stoves and they've got fridges and they've got walk-in coolers and they've got tables and chairs. And all these things get worn out and give out over time and have to be replaced. If you think about an office, they got desks and chairs and they got computers and various pieces of equipment that will either become obsolete or wear out. And in the rental business, of course, if they're renting tuxedos, those tuxedos are going to wear out. If they are renting cars, those cars are going to give out or wear out. And if they're renting tools, those tools are going to have to be replaced. So they're going to become obsolete, get worn out, and need to be replaced. And as a result of that, the Canada Revenue Agency has made provision for businesses to depreciate the components that make the money. Well, when you own investment real estate, you own a business. And the government recognizes that. And so they allow you to depreciate your components that wear out as well. And I want you to understand, though, how that impacts us on a daily basis and whether it's something we would want to do. Bear in mind that when you own real estate, you own land and you own what's called improvements. That's the bricks and mortar. Government allows you to depreciate the bricks and mortar, not the land. And the rule of thumb the accountants use is 75-25. So 25% of the acquisition cost is apportioned to land, 75% to improvements, and that 75% you can depreciate. Now the difference between, restaurants and offices and rental agencies is all their components wear out. In real estate doesn't wear out. Oh, it needs to be upgraded from time to time. It needs to be maintained. But overall, real estate goes up in value, whereas cars and tuxedos and the other things you are using in your business go down in value. So it's artificial a little bit, this business about depreciating, and it brings rise to something that's called recapture. What happens is when you sell your property, and I hope you don't, that's part of my money machine teaching, but if you sell your property, or when you pass away and leave it to one of your heirs, it's called a deemed disposition. At that point in time, there's tax that's payable, and there's something that's called recapture. But let's look at this depreciation first of all when it comes to real estate. They allow 4% of your improved part. So if you bought a property for $500,000, $125,000 or 25% of it would be the land cost, and $375,000 would be your improvement. And you can depreciate it at the rate of 4%. So that means in the first year, you can depreciate it by $15,000. Now, it's not a straight line depreciation, it's a reduced depreciation, gradual depreciation. So the next year, the base you work from isn't $375, it's $360, because that $15,000 has been used to reduce the capital cost. And so your amount you can write off the second year has depreciated or declined a little bit from what you can write off the first year. But keep in mind that over time it will add up and add up and add up. And in fact, take that property that you paid $500,000 for. After 10 years, if you use the maximum 4% depreciation each year, you have depreciated it by a total of $125,687.79. That's quite a bit of depreciation. What happens when you sell, or it's a deemed disposition? Two things. First of all, there's capital gain. And the capital gain is the increase in value on the property compared to what you paid for it. And right now, the capital gain is assessed at 50%. So that means for every dollar capital gain you make, you add half of it to your income tax. So if you make $100,000, it shows as a $50,000 increase in your income that year. That has to be taxed on whatever your tax rate is. The difference is recapture, you have to pay it back dollar for dollar. So in that previous example, if you were aggressive in depreciating it every year and then you sold it after 10 years, not only would you have capital gain to pay, but you would have to pay $125,687.79 recapture. That's money that would show directly on your income tax as though it was income. Well, you say, well, Wayne, if that's the case, why on earth would I want to depreciate? Well, let's go back again to the Money Machine seminar and review it. The philosophy is very simple. Buy one property a year for 10 years, never amortize over more than 15 years, and never sell. So you got an aggressive amortization schedule, and you've got a portfolio of 10 properties. So you're not just writing down $125,000, you're writing down $1,256,000. There's a big, big difference in terms of what your impact will be when you sell, but there's also a huge difference as you go through it. And let me show you, by way of a chart, I want to show you what happens during the process of paying down the mortgage because of the aggressive amortization schedule we're using. If you look at this chart, I'll put it on the screen, you'll see in year 2, the property equity, it shows us $67,739.05. Now, $50,000 of that is money you put in. It's a down payment. So you don't pay tax on that. But you're actually seeing an increase in value in terms of what you're paying off on the mortgage of $17,739.05. That is straight income that goes on your income tax, even though you don't see a penny of it. See, if you did a net worth statement, your net worth would go up by that much, even not counting anything about the property appreciating in value, just because you've paid down the mortgage. The government says, aha, that's profit, you're going to pay tax on it. Well, keep on going down the chart. Get to year 10. Year 10 shows that you have got a $263,562.95 increase in equity. Now, $50,000 of that was your down payment for your 10th property, but it also means that $213,562.95 came off your mortgages, and you got to show that as income on your income tax return. You didn't see any of it. Now, the bank sees it, the tenants paid it, but you got to pay the tax on it. And by year 11, it's $246,000. You don't have the $50,000 that you put in. It's $246,514. Looking at year 15, it's $324,610.50 that was paid off your mortgages. You say those numbers are staggering. They are, but they're absolutely accurate. That's how much money you're making per year in paying off your mortgages. Now, when the mortgages are paid off, that's money that goes into your pocket. When you retire, that gives you money to take trips, to fly first class, to stay in wonderful hotels, to eat in great restaurants, and so on. But on your way there, in that 15, 20-year period, and especially in the middle of it, you're not seeing the money, but the government says you're earning it. And you got to pay tax on it. And it's a huge amount. If you happen to be in a 53% tax bracket, and you will be because of the money you're earning off your rentals, you got to come up with a ton of money that you're not going to have. Well, there's a couple of things built into the program that give you relief. One thing is each year, generally speaking, rents go up. And in fact, rents have gone up almost exponentially. So if you have a tenant, over and above what the government allows you, if you have a tenant leave and a new tenant comes in, you can raise the rent, you can get more revenue coming in, although you've got fixed mortgage payments. And so that gives you a little bit of extra equity. Also, on year 11, that's a benchmark because you don't have to come up save that $50,000 anymore for a down payment. Year 16 is a huge milestone because your first property is paid off, and now all the rent can be used to offset your tax burden. But the other thing is you're going to really need this benefit of depreciation. If you've got $375,000 per property in depreciatable value times 10 properties, that's $3,750,000 that you can depreciate. And that becomes huge as far as, even at 4%, that's $153,000 that can go against your income. And so it's almost imperative that you depreciate these properties to ease your tax burden. Bear in mind when you do that at some point in time, when you pass away or if ever you sell, you're going to not only face capital gain, which you've got the money to do it, but you're also going to face recapture. It's a heavy hit, and that's another real good, and as I said before, it's a real good reason to not sell. Thank you very much for joining me on this video, and we'll look forward to talking to you the next series. Thank you.